Hi, my name is Ken Solo. If you don't know me, I'm the Chief Investment Officer of Pinnacle Advisory Group and one of the founding partners here at the firm. Today, we're here to shoot a video to try and get you up to date as best we can about the ongoing, our views anyway, about the coronavirus portfolio construction and strategy at a time where markets are extremely volatile, and we know many of our clients are anxious about what's going on with their portfolios. This is the time of year where we usually do inside the investment committee, or ITIC as we call it, and it would have given us an opportunity to give you this briefing in person. Obviously, we can't do that with the virus, so we're very hopeful that this video will be helpful. Two kind of quick caveats. One is we are going to try to do the post-production here from this video very quickly, so hopefully we can get this out to you. The news changes on a daily basis. Last evening, the European Union just put out new rules from their central banks. We're seeing news again on a daily basis. So hopefully what we're doing today will still be timely and relevant, at least we think so, and that'll be helpful for you. The second thing is, one of the favorite parts of the ITIC event that we do every year is clients getting an opportunity to ask questions. Obviously, we can't do that today in this video, but if in watching the video you do have questions, please immediately give them to your wealth manager. We'll take them on the investment team and get you any of the answers you want. Finally, just to get into the video itself, we're going to try and do a 30 to 35 minute video. I know you're all stuck at home anyway with nothing else to do, so you might as well watch a Pinnacle investment video. But nevertheless, we've given some thought to the issues that we need to tackle here. So I'm going to look at my notes. Forgive me, but I want to go through what we've got lined up for you. First, Dan Mento is going to talk a little bit about the coronavirus itself and our views about what we can expect there. We are obviously not virologists, if I'm pronouncing that correctly, but it is so important to what's going on with portfolio construction, we thought we'd start out with a few comments about what we see there. Dan will tackle that in a second. Next up will be Sean Dillon. He's going to give us some context about bear markets. We're experiencing the first bear market we've seen in a decade. The last one was during the great financial crisis. So I think Sean will help us out here with just what's going on in terms of the speed and the amount of the decline in markets. I think that'll be very, very good. Next up, we're going to ask Carl Noble to talk to us a little bit about recessions. Again, we have our first recession call here at Pinnacle since the great financial crisis once again. So Carl's going to talk a little bit about our GDP and earnings forecast, what that means to valuation, and hopefully that'll fit into our narrative. We're going to do a couple of bits of micro analytical business here for you. We're going to ask Sean, who covers the energy sector, to talk to you about what's going on with OPEC and oil prices. It's all very important and very connected to what we're seeing in the overall markets. So Sean's going to talk a little bit about energy. Next up, we're going to ask Dan Mento, who's our fixed income analyst, to talk about interest rates. And what's going on in the fixed income markets is also historic. We're seeing all kinds of moves we really haven't seen before, so we've asked Dan to brief you on what's going on with the portfolio. And then Carl is going to come back on and talk about government intervention in the markets. We're already seeing a lot of monetary moves. We're going to be seeing a lot of fiscal moves, and that hopefully is providing some type of a floor in the markets. It's important that we kind of review that because it's an important part of our strategy going forward. And then I'll finish up talking to you about strategy, what we've done so far, what we expect to be doing in the future. Hopefully, if we string all this together, It'll give you the kind of update you're used to seeing with iTick. We do have some charts for you, and hopefully this will be an informative video. So with that, I think we ought to get started. I've run on long enough. Let's bring on Dan Mento. He's going to be talking about the coronavirus and our views. Dan, take it away.
Thanks, Ken. Happy to make a couple comments about the coronavirus situation. Of course, as a reminder, none of us are virus experts. However, we are reading as much research as we can from people who are experts in this field. And what we have learned is there's basically three models in different areas of the world that we are following in terms of handling the virus situation. The first model is what I would call the China model. And what they did to contain the spread of the coronavirus in their country was viewed as pretty draconian at the time. They took some pretty severe measures to restrict travel, close down businesses. But as you can see on the chart, they were very successful over a couple months in stopping new cases from occurring. And so while the China model was very successful, we don't view that as something that's going to happen too stringently in Western democracies, because China is a bit of a unique situation with their communist government. We also are watching the South Korea model. Now, South Korea was able to successfully bend the curve and slow the spread of new cases with extensive testing throughout the country. Now, widespread testing for the coronavirus was able to identify those hidden cases that maybe the patients weren't showing symptoms, but they were still spreading the disease. Now, while this was very effective in South Korea and would be effective in other areas, we've seen stories in the US about shortages of testing, and so we don't think this is a model that we're going to be able to implement right now. I will say, however, that there has recently been a private-public partnership to ramp up the amount of tests available in the US, and that should hopefully be coming online within the next week. But we think the cat's out of the bag for the South Korea model being applied to the US. Finally, we have what I'll call the Italy model. Now, Italy has been ramping up their restrictions over time, similar to how the US has been. They've been restricting travel and closing down public places like schools and non-essential businesses, and only letting people really travel around for vital needs like groceries, maybe doctor's visits. Now, we have observed that the U.S. is kind of on almost a 2-week lag, perhaps 13 days behind Italy in the growth of new cases, as well as the implementation of a lot of the mitigation measures that we're taking in both countries. You can see on the second chart that on about a 13-day lag, cases in the U.S. are tracking cases in Italy, and so we think this is an applicable model to predict future case growth in the U.S. by looking at Italy. For now, we need more time to observe the mitigation measures in the U.S. and see if they are effective. If we do social distancing and other recommended practices by the CDC to prevent the spread of the coronavirus, we will play out the blue area, which is a slow, gradual rise in coronavirus cases, which never overwhelms the healthcare system. If we fail to do the social distancing and other mitigation, we are at risk of the orange area, which is a quick spike in cases, and that those patients would be exceeding the current healthcare capacity. So for now, our base case is that we will follow the Italy model on about a 2-week lag, but right now in the US, there's still a lot of uncertainty, and that uncertainty is being priced into financial markets now with all the volatility that we're seeing.
Thank you, Dan. Fantastic. Next up, we have Sean talking to us about bear markets. I think it's important for us to keep what's going on in some context based on history. So with that, let me introduce Sean Dillon. Sean, give us your take on bear markets.
Thanks, Ken. We're certainly in some interesting times right now. Putting this in context with history, we have now experienced the fastest decline in the S&P 500 and Dow Jones indices ever. We have gone down 20% from an all-time high in just 16 days, which eclipses even 1929 and 1987, which are historic events in their own right. So there's a lot of fear that is being built into the markets with the speed of what's happening. And you can see that being reflected in a lot of different technical indicators. You can look at one specifically that's very easy to look at, the CNN Fear and Greed Index. We have moved from greed to extreme pessimism in just a month. So it's a really sharp move downwards in terms of sentiment and these indicators. Some of the things that compromise the fear and greed index include high yield spreads that have moved back to 2009 levels. In just a few weeks, I think they've moved to 900 basis points over treasuries, or 9% over treasuries in terms of yield, which is a pretty strong move in just a few weeks. Stocks over the 200-day moving average have crashed. Only about 4% of stocks are trading above the 200-day moving average, so that's also consistent with recessionary periods, 2008 and 2000. And then another notable one would be the VIX. We have a chart here on the VIX. The VIX has exceeded the great financial crisis levels of 80. We've moved into the mid-80 range over the last few days. And you can see that playing out in markets on a day-to-day basis. If you look at the 20 worst declines going back to 1929, 4 of them have occurred just in the last few weeks. And in fact, the second worst decline of 11.5% happened last week. So definitely some historic moves in terms of the stock market. And you can kind of see why. If you go back to the beginning of the year, it feels like forever, but it's only a few months ago. And at the time, we were looking at an economy that had pretty decent footing underneath it, decent housing market, consumers were relatively stable. And that dramatically changed just over the last few weeks. And now we're looking at a recession call. Forecasts of GDP growth in the second quarter that is very negative, double-digit declines in terms of GDP growth. So people are repricing a recession immediately, and that's really why we're seeing these declines. And the decline itself is about 30% or so, depending on what index you're looking at. However, if we are in a recessionary bear market here, which we do think we are, then we're probably going to experience more downside. Typical bear markets will fall 35 to 40% on average. Again, we have the statistics here for you on this chart here, and you can see somewhere around 39% is the average, and that would take us slightly more to the downside than we currently are at this point. So we do expect to see some modest or some little bit of movement to the downside still, even after this decline that we have had. What we are going to look forward to is some recovery studies. If you look on the right side of this chart, the recovery studies show that on average it takes about 25 months in order to recover the damage or move back to new highs in terms of the stock indices.
That was great. Thank you, Sean. Next up is Carl Noble. We've asked Carl to go through and talk a little bit about recessions, what that means in terms of GDP and economic growth, also what that means in terms of earnings forecasts and valuation. So I think that's a really important take. Carl, take it away. Thank you.
Thanks, Ken. Unfortunately, at this point, it does appear that the global economy is headed into a recession, and that would include the United States. And this is largely based on the fact that governments around the world are increasingly choosing to ask people to stay home as much as possible and effectively shut down large parts of their economies in order to stop the spread of the virus that's occurring right now. And that's completely understandable from a public health standpoint, but the flip side of that is that it's going to deal a significant blow to the global economy and also here in the U.S. What we're seeing at this point is that economists are racing to revise down the estimates that they previously had for this year. And if I could rewind the tape just quickly to a few weeks ago, which seems like quite a long time ago at this point, but when the news of the virus was first coming out in the headlines, what was often being done was comparing what happened in previous virus outbreaks, whether it was SARS in 2003 or H1N1 in 2009, and sort of using that as a playbook in terms of what we could expect this time around, meaning that on average, those episodes suggested that from an economic standpoint, you could expect a little bit of a slowdown or a very brief dip, but then a subsequent sharp rebound. And likewise with financial markets, maybe a little bit of volatility surrounding the outbreak. But then as it appeared like it was under control, financial markets tended to rebound fairly quickly in those previous episodes. We'll fast forward to today, and I think, with what all of us have learned and know now about this particular virus is that it's very, very different than those previous episodes. The way that it continues to spread and its global scale means that this is just something that really none of us have seen in a very, very long time. And so, if we look at the first chart here, we're seeing that, economic growth is anticipated to come down over the course of this year. Now, the line that you're looking at is an average of a number of different economists. And so for the second quarter, they're looking for economic growth to be around zero based on this average. But what I can tell you is individual estimates are increasingly much lower than this. So 0% growth for the second quarter is probably on the very optimistic side of this thing. And we've actually seen numbers that are as bad as potentially minus 5% GDP growth annualized for the second quarter, or potentially even worse, depending on the response to this and how much more they're willing to shut down parts of the economy to battle the virus. So we're seeing a very wide range of forecasts at this point. I think part of the problem is that we're still working right now with a limited data set. Events are moving so quickly that the impact of the virus isn't even really showing up in a lot of the popular economic indicators. Over the last few days, we're actually just starting to see some of the most real-time data and some of the effect that it's starting to have with some precipitous drops in certain things. Just today, we saw a pretty large jump in weekly jobless claims, suggesting that increasingly, people are being either laid off or asked to stay home in response to this particular virus. So, economists are scrambling to not only catch up, but are working with limited data, and that's resulted in a very wide range of estimates for the second quarter, as well as the third quarter. I think some people anticipate that if the virus can be contained fairly quickly, that third quarter growth might actually be a little bit better, and then we could experience a healthy rebound heading into the end of the year. But there are others that are a little more pessimistic that think, no, third quarter growth might be negative as well. And the rebound that everyone would like to see might be a little bit prolonged and pushed off into the future. So, I think for us, our expectation right now is that third quarter growth will likely be fairly weak as well. But assuming that the virus does get reasonably contained over the course of the summer or sometime in the next couple of months, that we do think that there's a chance that later in the year, potentially at the end of the third quarter or the beginning of the fourth quarter, that we could start to see a fairly sizable economic pickup that would be characterized by a lot of pent-up demand on the part of consumers that are, asked to stay home and not really live their lives the way that they're accustomed to. They could start to get back to normal, and that could result in a fairly large upswing when that is able to occur. Now, taking what I just talked about as far as the economy goes and translating that to corporate earnings, I think it's probably a similar pattern as far as our expectations go. Coming into 2020, as the chart you're looking at now shows, expectations for earnings growth for this year were around 12%, so that was fairly healthy. Now, there was a little bit of a nuance of some analysts looking for softer earnings growth in the first half of the year and better growth in the second half of the year. But I think at this point, it's safe to say that estimates across the board are still too high. As we stand today, earnings growth has been marked down from 12% to about 8% for 2020. But we still think that is quite a bit too high, considering what's actually going on now. And analysts covering companies out there are having the same problem as economists, meaning a lot of companies aren't offering guidance anymore. Analysts don't have a lot of information to work with in terms of how they should be revising their estimates. But I think it's safe to say and safe to expect that estimates are going to come down quite a bit as more information emerges about the damage that to the economy that this is causing. So for us, I think certainly in the second quarter and probably in the third quarter, earnings are likely to fall and potentially by quite a bit in the second quarter. But again, if the virus is contained at some point in the next few months, then along with an economic pickup later in the year, we could see earnings expectations start to move back up as well. And then also translating that to valuation, we came into this year with the multiple on the S&P 500. So comparing the price to expected forward earnings was around 19 times, which historically speaking was on the higher end of the range, suggesting that the market was fairly expensive at the time. But the way that the market has reacted to that and the declines that we've seen means that has already been marked down quite a bit. I think as things stand today, we're around 13 to 13 and a half times forward earnings now compared to 19 at the beginning of the year. So there has been quite a bit of a repricing already, and the market is starting to become more attractively valued. Now, that's not dirt cheap. Back in, for example, back in 2008 or 2009, that the multiple went down to around 10 times earnings. So we could still have a little bit of a ways to go there, but it is safe to say that the repricing that's occurring now is improving valuation in the market. Our own valuation model internally suggests that valuation has returned to neutral from showing that it was fairly expensive coming into this year. So, there are, at the moment it's hard to see, but there are some positive offsets for that as far as what could occur, again, once the spread of the virus is contained, meaning that, the market may be able to regain its footing with a better starting point as far as valuations go.
Carl, that was excellent, very interesting stuff. Next up is Sean Dillon. As I mentioned before, Sean covers energy for us here at Pinnacle. Lots of news in the oil patch. Sean, could you give us an update?
First, let me step back and provide some context for where we are in the energy space. Going into last year, we had no exposure to traditional energy equities. We had our exposure through master limited partnerships, and that provided some really great relative performance for us. However, as we moved into the end of last year, we thought we were seeing some global green shoots in terms of growth worldwide, and that is usually a fantastic environment for energy equities, and we moved back to neutral on the energy equity space. Going into this year, obviously our forecast has changed with the virus outbreak and a potential hit to GDP worldwide. We reassessed the energy space and decided that it was a very easy sale at that point. So we moved out of the energy equities, going to zero exposure. And that was based on a demand forecast that was really going to take a hit. When you're looking at travel restrictions in China, travel restrictions between US and Europe, and then intra-Europe as well, demand will take a big hit in terms of oil demand. What we saw in the great financial crisis was about a 5 million barrel hit to demand to the downside. Right now, forecasting about 4 million. So very similar in terms of demand destruction that is happening. And that's really not a great thing for energy equities, obviously. What we did not forecast was what would happen next, and that was a supply issue that also coincided with the demand issue. So as demand was moving lower, we're having this supply issue. Saudi Arabia, OPEC, and Russia got together over a few weekends ago, and decided that they were going to not only not cut production, but they would increase it, specifically from the Saudi Arabia perspective, and then also slash energy prices to some of their major trading partners around the world. And this has unleashed chaos in the markets. Oil prices have moved to $20, which is the lowest price in over 25 years. And it's really starting to hit the U.S. shale production space. Perhaps this is one of the goals of OPEC. Maybe they wanted to make sure that the U.S. energy production moves lower and that market share is regained by them, and it's working. You're seeing it play out in high yield, especially. That's where we're seeing the most stress. So a lot of the energy companies that are in the exploration business have in the high yield index as well. If you look at the S&P 500, 2.5% of the stock market is in energy stocks. However, in the high yield market, it's around 15%. So a much bigger piece of the high yield market, and high yield has also reacted to the downside pretty negatively. You've seen a sharp decline over the last few weeks. High yield has moved about 16% lower. And the energy space, you can see on this chart here, has moved about 48% lower as well. So it has been a great sale in just a few weeks. We did the sale on 3/3, but equity markets in the energy space have moved pretty dramatically lower. And from here, we'll have to start reassessing our exposure. As you can imagine, valuations have been dramatically slashed. I'll give you one example. ExxonMobil, the biggest company inside of the energy space, has moved to an 8 times forward price to earnings ratio, which is incredibly cheap. They have a decent dividend for now. So you're seeing some great values. And as we look to exit the crisis, this could be one space that we need to get back to neutral in, but that remains to be seen, and we'll make that decision when it comes time. Another positive that is happening is obviously energy prices moving lower is great for the consumers in the U.S. Gas prices should react to the downside, maybe even get back under $2 a barrel with prices in $20. And then energy heating prices should also react to the downside. So that should support the consumer as well when we're ready to move past this, perhaps in the fourth quarter.
Wow, that's amazing stuff. Next up, even more interesting news here of late. We're going to ask Dan Mento to come on in and talk to us about what's going on in the fixed income markets. Dan, help us out here.
As bond markets have begun pricing in the impact of coronavirus, we've seen some really volatile moves recently in different areas of fixed income, similar to in equities. While there are a variety of ways to invest in fixed income in all sorts of different sectors, I'm going to focus on a couple winning trades within the prime portfolios: treasuries, corporate bonds, commercial paper, and municipal bonds. Starting with treasuries, the Treasury Price Index is directly linked to Treasury yields. As the Federal Reserve has lowered interest rates back towards zero, the broader Treasury market has followed, with interest rates falling to record lows. From the fourth quarter of 2018 through this month, the 10-year Treasury yield moved from over 3.2% to below 0.4% before bouncing higher. As you can see on this chart, it's a really significant move. As yields have plummeted to close to zero, Treasury bond prices have provided some positive returns within the prime portfolios. What's interesting, though, is that over the past couple of days, and Carl will get into fiscal and monetary stimulus a little later, we've witnessed Congress talking about trillion-dollar-plus stimulus plans. Now, of course, this $1 trillion is not money the federal government has. It will be adding to the federal debt. And as the federal budget is getting blown out even wider than it already was, we've seen Treasury bonds sell off a bit. And this will be an interesting development to follow. Moving to corporate bonds. Corporate bonds are a sector that has struggled recently. As revenue and profitability projections are brought down, the inherent riskiness of corporate bonds is rising, as corporations will have less cash flow to service their debt. This has led to some pretty severe selling for corporate bond investors. In the prime portfolios, we were positioned for this. We have been worried about corporate bond valuations for quite some time now. So coming into this downturn, we were significantly underweight corporate bonds. Additionally, the majority of the corporate bonds we do own are shorter duration, which is less volatile than the longer duration benchmark. Additionally, as selling pressure has continued, we've seen some warning signs in the commercial paper market. We monitor commercial paper indicators for indicators of financial stress, but also because we invest client assets in that. For a while, we held an ETF called GSY, which invested in commercial paper because it had a higher yield than Treasury bills. Recently, as indicators of financial stress rose, we sold out of this GSY ETF, and it was a good sale and prevented further losses. As the selling pressures continued, commercial paper has suffered. Now, those funds are sitting in a money market fund, and we don't see the same warning signs in money market funds as we do for commercial paper. But if we did see those signs, we have the full flexibility to invest those funds into Treasury bills. Finally, I want to highlight municipal bonds. As municipalities will be under increased financial stress, muni bonds have sold off pretty sharply, similar to credit. Now we see an opportunity. Municipal bonds currently yield well over what a Treasury bond yields, even before accounting for the tax benefits of tax-free interest. While we're not ready to jump in right now, as selling pressure could continue, this is a unique opportunity that we'll be monitoring closely going forward.
Thank you, Dan. I'm sure we've really never seen anything like this before. So an important update. Next up is going to be Carl Noble talking about some things we actually have seen before during the great financial crisis. Carl, if you could give us an update on what's going on with monetary and fiscal stimulus, I think that'll be very helpful.
If there is a positive offset to all of this, it's that we're increasingly seeing a policy response on the part of governments around the world. And this really wasn't the case a few weeks ago. I mean, I think there was some deserved criticism that governments were somewhat behind the curve in terms of how they were responding to this, not only on the health side, but also on the economic side, meaning central banks and fiscal planners and that sort of thing. But at the moment, over the last week to 10 days, we've really seen finance ministers, central bankers around the world really jump into action and start to do everything that they can to try to soften the economic blow that the virus is going to have on the global economy. So just taking as an example what's been going on here in the U.S., a couple of weeks ago, the Federal Reserve on the monetary side of things had an emergency 50 basis point rate cut. That was the first emergency rate cut we had seen since the great financial crisis back in 2008. But that was just the first step. Since then, and we're almost starting to lose track, there have been a series of measures that they've taken, including a second emergency rate cut, bringing short-term interest rates down to about zero again, as well as increasing the size of asset purchases that they're doing, and also reintroducing essentially this alphabet soup of different types of lending facilities that were rolled out during the great financial crisis, all of which are designed to address certain pressures that they're seeing in various parts of the market, some of which really aren't in the headlines on most days. Some of these are occurring in very niche parts of the credit markets, short-term lending markets. All of these different places and the way that the market is behaving has certainly concerned the Fed quite a bit, and now they have jumped into action to try to address that. So the monetary side of the equation is in full swing at the moment in a way that we haven't seen in over a decade. And while that may not be having an impact in the short term, we do think that will, over time begin to take traction and at least help to soften the blow. And then that is now being combined also with what we're seeing on the fiscal side. So the federal government is already at this point, I believe, on to their third fiscal program that they're considering to try to pass to help out not only businesses that are struggling, but increasingly workers that are being asked to stay home and that sort of thing as well. So, this started with trying to fund the health crisis itself and making sure there was enough money allocated for testing and supporting that cause, and that was easily passed. The next steps have been to try to support workers who need paid sick leave and that sort of thing. And then now they're actually talking about a very large dollar figure, all-out stimulus that, again, would be spread out across consumers and businesses and try to allow the economy to get through this with the least amount of pain possible. There will be some pain, unfortunately, but hopefully with what they're doing, that will allow the consumers to get through this and, subsequently potentially increase the size of the rebound that we see on the other side of this as well. And the only other thing I would add is that this is certainly not contained to just the U.S. We are seeing this on a global scale. There have been plenty of countries around the world now that are pairing in a similar way, not only monetary, but increasingly fiscal stimulus to try to combat this. And the numbers are really starting to add up. I think we are into the couple of $1 trillion mark at this point, and it looks like it's likely to increase. It hasn't overly impressed financial markets at this point, but we think when some of the panic and fear dies down and people realize how much stimulus is in the pipeline, again, hopefully the virus is starting to be contained at some point in the relatively near future, and there will be a very, very sizable amount of stimulus that should allow economic growth to recover more quickly than it would have done otherwise, and allow businesses and consumers to get through this in the best way possible.
Thank you, Carl. So let me finish up by digging a little bit into strategy here at Pinnacle, what has gone on in the portfolios here, trying to give you some context with that, and then looking into our crystal ball as how we might move forward. It seems like a long time ago, but last year we were fighting an entire different type of war. It seemed like for most of the year, this year we're fighting a war against a virus. But last year we were fighting a trade war. And it turns out that we spent most of the year trying to add risk to the portfolio. We had this terrific bull market last year. And as you can see on the chart, we're showing you the relative volatility of our portfolios versus our benchmarks went from a low in the very low 80s all the way up to where we got to the beginning of the year. It was tilted just slightly bullish. Valuations we thought were high, as we told our clients, made it very difficult to get more bullish than we were. But we were looking for some type of a pause or correction. Believe me, we weren't looking for what we have now. You can see at the far right of this chart just how quickly we have unwound that bullish position. And we've tried in very volatile down markets to intelligent restructure this so that we could get it to a bearish position, which would be appropriate due to our forecast of a recession here coming up in the second and third quarter. I wanted to talk to you a little bit about how we did this. The chart you're looking at shows the trades that have gone off in the portfolio since the market top. Really, two types of trades that we're showing you here. One is there's only one of them. We call them a neutral rotation trade, where we're selling one security, buying another, but it doesn't have a material impact on portfolio volatility. The other type of trades that look like a dot, a red dot on the chart, are rotation trades that do impact beta, reducing beta or volatility in the portfolio. And then the triangles that you see are trades where we're actually raising cash. And you can see a really mix of red triangles and dots. Interesting to me, if you take a look at the last 4 transactions here on the right-hand side of the chart, you'll see that we were able to execute 3 of our sales on big up days in the market, which were well-timed in my view. The one that was less well-timed was when we sold home builders and pave or industrials. The only thing I would note is when you get into extreme bear markets, every time the market makes a new low, every sale you did, regardless of the timing, looks heroic. That was certainly the case in that transaction. Home builders are trading right around, as we're filming this, about 20% below where we sold it, even though we sold it on a vicious down day. So you can see a lot of work, a lot of trades. We thank you for your patience as we've been incrementally restructuring the portfolio. The outcome of all that is that when you look at the sector holdings in the portfolio today, we are extremely underweight the late cycle sectors of the stock market. We own no energy. We're out of materials. We do have a position still in industrials, but we are underweight. In the early cyclicals, we are very much underweight financials. Interestingly enough, we still have, I believe, a slight overweight to technology, which has actually been holding up relatively better than I would have expected. And we're now, as a result of these transactions, overweight to the more defensive sectors, which, as you might imagine, have been doing better than the rest of the market in this sell-off. So utilities have been doing relatively very well. Consumer staples very well. We've been adding to healthcare. We think healthcare is an interesting story, good valuation story, but obviously with the virus, maybe a better fundamental story. So at this moment, we're pretty satisfied. It took us a while to get here, where we're now overweight defensives, I think, properly, and underweight late cycle and early cyclicals in the portfolio. Moving on, I want to talk a little bit about what we might do going forward into the portfolios. And honestly, that has a lot to do with two different issues. One is valuation of markets, and the second is just price. So I want to quickly spin through that. Market valuations for most of the last 10 years, in our view, have been expensive. The market has continued to rally, especially for the last 5 years, where due to our scorecards and our internal work, we think the markets have been overvalued, especially last year. This bear market is correcting that in a hurry, just based on forward PEs, based on what Carl was just talking about and our work. Forward PEs have fallen from 19 times earnings down to as low as 13. So if those metrics continue to get lower, I think you could expect to see us to begin to start rebalancing the portfolio and even adding back to risk. So we're keeping a very close eye on that. The problem is that earnings visibility is very low. Everybody's just guessing how low earnings might fall. But still, if you go out 2 or 3 years, if you're buying at very low multiples, we believe we're going to make money for everybody. So that's one thing we're looking at. The other thing we're looking at is just prices. Often prices themselves give you a clue as to what's happening in the markets as they try and find a bottom. I think this market bottom could be very messy as the market grinds lower, but eventually the market could be giving us some hints that we've seen the majority of the selling. If that's the case, we'll come back in and begin nibbling again. We're not going to be, the high probability is we won't be able to exactly time a market bottom, but we haven't gotten that far out of the market at 85% of vol. We've been much further out in the past. This is going to allow us to be a little bit patient on when we get in, and we have a pretty high confidence that, especially the virus news, if the virus news begins to improve, which they'll know when we're going to see a peak in cases, or it might be news in terms of treatment or vaccines. Any of that news could put a bottom in the market, and we'll begin to start buying. Let me just finish by saying that in all bear markets, you have to be patient. In this particular bear market, the level of fear is greater because there's issues of our personal health. It's really very frightening and anxiety producing. We're going through a pandemic. Bear markets are tough enough and scary enough without layering a pandemic on top. But if you go out a year, 2 or 3, the markets are not broken. This is not so far like the great financial crisis. We don't see the same stress on institutions as when Lehman Brothers went bankrupt. This is a health issue, a public health issue. We think when we get past it, we could see very big, very strong, very fast recoveries in markets. So the best thing to do is hunker down at home, be safe, practicing your social distancing, washing your hands. And when it comes to investments, let us do the heavy lifting here. Take a deep breath. I know it's very frightening what's going on, but we think on the other side of this, we're going to quickly get back to very strong returns. There is a lot of pent-up demand that's building and a lot of stimulus in the pipeline. In the past, that's been a wonderful cocktail for higher prices in the future. So I hope this helps. As I said earlier, if you have questions, let us know. Thank you for watching. We appreciate it.